Good evening to all of you. Welcome you to today's webinar. Today we are going to look at the market developments because Nifty and Bank Nifty generally are falling for the last couple of weeks right now. So it would have definitely raised a lot of questions regarding where this bear trend could stop or where this bear the correction in a bull market, whichever way you want to call it, and where this is likely to stop. So that's normal concern which will be there in the minds of everyone, and also whether this is the right time to go for some investment, and also whether we should add on every fall. So for that we will look at the charts, both Nifty as well as Bank Nifty. We also look at some stocks also, and we will continue the discussion in coming webinar also. So we will first straight away go to the chart right now and look at the Nifty. So this is Nifty chart, and Nifty has fallen from something like 18,600 to 16,400, which is 2,200 points. So 2,200 points represents a fabulous correction as in percentage terms. It comes to 2,200 divided by 18,600. It comes closer to 12%. So 12% correction has already taken place, and this is a very quite a healthy sign for the market. So it has already corrected 12%. Normally, no, unless there is very big problem where the market goes down to something like 18% to 20%. So unless the Nifty, there are serious issues, Nifty probably could be looking towards some sort of a bottoming out at this particular level itself, which is around the 16,250-300 mark. So we will just explain why the 16,250 is important. Now 16,000, for that we will go back to the chart. This is a daily chart. Okay. In the daily chart we are looking at this red line is the moving average, which is a 200-day moving average. So generally what divides bear and bull scenario generally is a crossover of the 200-day moving average. That is from that technical point of view. Okay. So normally it doesn't mean that once it crosses below 200 moving average, it probably could be looking towards even a bottom of 6 to 7% from the 200-day moving average. So this 200-day moving average now at 16,250 levels, and this is expected to provide some solid support. Probably some plus or minus something can always happen, because markets don't exactly come exactly to that place or doesn't stop. It could be a few points below, a few points above, but approximately around 16,250 is where we see probably good amount of support that could come for Nifty. So this is from the moving average point of view. And also we have drawn parallel trend lines, which also looks to be giving resistance on rally and also supports at the fall. So this parallel trend line is also slowly dropping towards the 16,250 at the bottom side, which means that we have a 200-day moving average there, and we have parallel lines also coming closer to the 16,250. And around 16,000 also represents something like the first Fibonacci support for the entire big move, which started from something like 7,500. If you remember, the pre-pandemic level was 7,500 levels. So approximately 7,500, and right now it is 18,600 it went. So this is represents something like 11,100 points, right? So into 0.235. So this is the first area of Fibonacci support for the big move, which is 11,000 into 0.235, approximately 2,585 points. So 2,600 points if you take and subtract from this, it comes closer to 16,000. So the 16,250 is where the 200-day moving average is. There's 23.5% retracement comes closer to 16,000. There is enough trend lines on the parallel on the downside, 16,000, and probably 16,000. So probably the 16,000 could also mark something like a 2,600 points, which represents something like 2,600 divided by 18,600, and that comes closer to 14%. So good chance that probably we will stagnate closer to this place and then probably we could see equity markets indexes as well as stocks recovering from this level. Now in the last 1 month or so, again the new variant is threatening, and probably at some stage there, I think the markets will start to factor the negative impact of this new variant, and there could be a probable recovery from this problem right now, which market probably could also look towards taking support and then recovering once we know that this is not that threatening as it used to be before. So to that extent, the panic will slowly start to settle down, because the panic that has been created already has been now factored, and the markets have already fallen something like 13 to 14%, which is a deeper correction. But if you look at the global market, particularly the US S&P, the fall is not much. The fall is something only 5.5 to 6%. But there the rally was much lower when compared to the Indian market. So to that extent, it is slightly making some adjustment for what has happened previously. So but the fall there in the equity market is still not threatening. It is moving up and down, but the percentage of fall is still stagnating closer to 5.5 to 6%. From US S&P, which was 4,740 or so, right now it came down to 4,250 or so, like that. No, sorry, 4,000. It was let me look at the chart. 4,400 or so. S&P. So if you look at it, this is 4,740 and this is 4,500, so 240 points. So 240 points represents less than approximately 240 divided by 4,740. It's less around the 5% mark. So there the fall is even much lower, and it has stagnated closer to the 5% mark there, and it is taking support closer to the bigger moving average. It does not even come closer to the 200-day moving average. So to that extent, global markets, particularly the US market, is still not in any threatening mode, which means that there is a very shallow correction in the global market, particularly in the US stock market. And in India, the correction is more than double of what has happened in US market. That is because there is an adjustment that is going on for the rally that took place in the Indian market. So right now we are still live and kicking, because if you look at the last 1 year performance, December to December, it is quite spectacular, right? So let's look at the Indian market on a year-to-year basis or in a 2-year basis also. For Nifty, just a minute, please. Shall I continue? So last year December the close was 13,981, and today we are at 16,500. So this represents something like an 18% rally. This represents something like an 18% rally, and over a period of 2 year time frame, if you look at it, it was closer to the 12,400 mark 2 years back. That is, if you look at the 19 figure, which is the so this is 12,168. So that time it was 12,200, let us say, and this is 4,300 points, which represents something like 35% and 17%. So 17.5, 18% per annum. So in the last 2 years, the market has grown something like closer to 18% per annum, and year on year it is also around 18%. So the general average, the Indian equity markets generally grow at something like 10 to 12%, and this time it has taken off well within 18% per annum. So the last 2 years is also around 18% per annum. And if you look at the last 3 years performance, which is the 2018, 2018 was 10,862, 10,862, and so right now 16,600 minus 10,862 divided by 10,862, that comes to something like 53%. Last 3 years 53%, which divided by 3, approximately again 18%. So I think the last 3 years the return is coming closer to 18% per annum. 2 years is also 18% per annum. 1 year is also 18% per annum. So that shows very clearly that we are in a good situation, that we are in a very, very good situation. And generally over a period of 3 years, this is the normal, this is the what we would say is the one standard deviation. So almost I think we are come very closer to that, and the market correction is basically to correct itself to a very normal level, which is the average level of 3 years plus one standard deviation. So I think we are at a decently comfortable level right now, and from here we have to see how the market works up, and probably next year we will scale some new highs. Generally on a year we normally get a good return. Okay, there has been only in the last 25 years or so, only there has been 5-6 years where when we had some negatives compared to the previous year, which means 18 to 19 years we have ended always on a positive note compared to the previous year. So right now we should now look towards the recovery which is to take place from here. Probably even if it's going to get 12 to 13% return next year, so we should see another 2,000 point rally next year from this level. So we should be comfortably crossing that 18,600 and head towards some higher levels next year. So we are looking at some sort of a quite a decent gain next year, and the correction of around 13-14% now has given us the chance. So from the technical point of view and from the statistical point of view, I think the market is looking ripe towards investment, because this 23.5% retracement coming closer to 16,000 offers fabulous opportunities for us to go on the long side of the market, right? So this is one way of looking at it, and also on a monthly chart, if you look at it, there is nothing abnormal right now. There is only a correction that is taking place, so there is no need for panic. This one. So for traders, probably yes, there could be. For investor, we are talking about from the investment point of view. So let us look at where the trading positions normally come. So it depends on what type of time frame that you are going to take. So let's look at the daily chart. Now in the daily chart, of course, the trend is on the downside, so we need to really clear certain levels. And at this point of time, it looks as if this particular close has to be taken off, which is 17,500. Now 17,500 is one, and then probably we need to take at least this particular low. This is low is 16,912. So there has to be first a close above 16,912. There has to be a close above 16,912 to consider going on the long side, keeping this close basis as a stop loss, which is 16,600 levels. So first of all, we need to look at something like a close above 16,912 with a stop loss on a close basis below 16,610 for a probable rally towards 17,330 or so. Now something between 17,250 to 17,300 to reinstate a bullish situation as far as Nifty is concerned. Right now, any rally in Nifty, if it takes place, probably it can have some resistance, which will be closer to the 17,250 trend factor, as a sort of a trend factor. It's also called a Stan Demark trend factor, which we have talked about it in the past also. So that 5.5% is one area which is normally taken there. So let me. So we have a 5.5% situation. So assuming the market is 16,410, if it is assuming it has bottomed at 16,410, then we need something like a 5.5% from this level. So 16,410 into 1.055, it comes to 17,300. So we need to clear something like a 17,300 mark before we go on the long side. Suppose if it falls to 16,250, then this will automatically get a little bit reduced. So 16,250 into 1.0555, which comes to 17,140. So somewhere around these marks have to get cleared at some stage before we go in the long side. So right now I would say the bullish situation will get reinstated above 17,310 for a climb back to 18,600 plus. So just look at it. If you are a trader, just want to look at first of all a reasonable gain before you start doing it, then please ensure that you are on the long side once 17,310 is crossed, and then you can go on the bullish side. But right now for an investor, it is offering opportunities to go on the long side without waiting for a trend to get reinstated, because then you will always be buying at something like 5.5% from the bottom, right? So right now it is a good level for you to look towards on the long side of market having corrected by 12 to 13%. So this is from the trader perspective, that 17,310 has to be clear for a positional trader. Now I would say if you want to be on the intraday then in that case what you should do is that now see today let us say at the close of the day, this is a 1 hour before the day, it has come to 16,803. Now from the classical Dow theory that we have a bottom here, and if this high is to be penetrated, 16,803 is going to be penetrated, then in that case we have a higher bottom on the hourly side. See, this is one bottom, this is another bottom, right? So this will get penetrated. So what you can do is you can look towards going long above 16,803, keeping 16,690 as a stop loss. So for those who are trading on an hourly chart, the suggestion is that you can go long above 16,803, keeping 16,690 as a stop loss. Keeping 16,690 as a stop loss. And that probably could be helpful, or probably on the reverse side, if the market is going to fall, then in that case you can go below 16,690. So those who are looking towards a very small trading call, immediate trading calls, should look at this. So 16,805 on the upside. This is, I'm talking from the spot side. So spot index has to cross 16,805 or 16,690 does to break. So these are two important levels which you can look for tomorrow. In case if the market opens and starts going above 16,805, you can do that keeping 16,690 as a stop loss. So those who are looking at some 100-point stop loss can look towards trading this. So this is from the hourly time frame chart, that tomorrow what can happen if it breaks above 16,805. From a trader point of view who builds up huge waiting for the big trend to break, chances that you need to wait up to 17,300 mark. 17,300 mark. Those who are investment oriented should look towards a dip 16,400 to 16,000, anywhere around this. It can bottom out and start moving up. So for investor, I think you should look towards right now itself as far as Nifty is concerned. So now we will look at the Bank Nifty. So Bank Nifty, we'll look at the daily chart. Bank Nifty, the issue is that now it has crossed below the 200-day moving average. So to that extent, it looks to be bearish. But as I told you earlier, that it does not mean that a complete fall below 200-day moving average. There is a chance that probably it can bottom out also very quickly. Because if you have seen, of course, this is the first time that we have seen since the bullish market got instated after the pandemic,
This is the first time it has crossed below the 200-day moving high. It has crossed below the 200-day moving average. So let's look at what possible situation holds for this market for Bank Nifty. So we will look at the slightly bigger chart. So what we will do is that we will draw a trend line connecting this top to this top and look at a parallel line. So now it is almost touching the parallel line and is slightly looking towards even breaking that particular line. Let's see whether this is this particular month it holds on this particular bottom or it still starts to fall. If it starts to fall, then in that case, these are lines which probably then we have to look at various. If this is going to be broken, if this line is going to be broken again, then in that case we may see a slightly bigger fall, and it could come up to the 20-month moving average, which is 30,450. Hopefully that should not happen, mainly because the index looks still pretty much look like bottoming out. So if that be the case, then we should hold on. But in case if situation worsens, then we should be prepared for a move right up to 30,400 as far as Bank Nifty is concerned. But if you look at the Fibonacci, let's look at the Fibonacci levels. Where does the Fibonacci retracements look like? Bank Nifty has broken the 35,780 levels, was broken a little decisively. That was the first 23.5% retracement. So the 38.2% retracement now comes to 31,980. So there is we have to keep our fingers crossed as far as Bank Nifty is concerned, whether there can be a deeper fall which could take it right up to 31,980, because it has crossed below 35,777, which means any rally that you get, a slightly deeper rally that if you get also, there will be a lot of resistance before Bank Nifty clears those hurdles. So let us see where all the Bank Nifty can face resistance. We look at the daily chart. So daily chart has got multiple moving averages coming at the top, which means it has to clear 37,880 or 30,890, or at least this top. So we need to clear 37,600 decisively. We have to cross 37,000, because by the time this moving average can also keep falling. So we need a clearance above 37,000, this high, which is the 37,580 or 600. So right now it's 34,607, right? So it has to clear this particular 37,581. If not, at least let's look at the so we may have to clear something like 37,025. So we have to look towards a bigger thing, which is 37,000 and all. So which is approximately 8 to 9% away from, or even 10% away from the present level. So Bank Nifty on any climb could face some sort of serious resistances, then push down, then only probably we can see some sort of a rally coming across as far as Bank Nifty is concerned. So Bank Nifty at this point of time does not look good, does not look still good. So it has to clear some lot of hurdles before it starts moving up. But at that point of time, you may think that you have missed a level to go for a long. So let's look at what probably the weekly chart, where the weekly moving averages are coming. So weekly moving averages are quite deep right now. So since this yellow line, which is a 20-week moving average, was crossed, we started having greater fall. So which is coming closer to 37,002. So very difficult as far as moving averages are also concerned. Bank Nifty is poised then in that case to go much lower in case if things worsen. So I think Bank Nifty is underperforming, and already the fall of 34,607 from 40,829, which represents more than 7,000 points, is approximately a 15% fall already that has taken place. There is a chance that probably we could be having some more fall as far as Bank Nifty is concerned, but we can't predict markets very easily. So when we are looking at some sort of a fall, it could still probably rise. So at this point of time, let's keep our fingers crossed and hope that Bank Nifty recovers. But Bank Nifty recovery, so considering the bearish situation, it is better for the trend to pick up before you go long on the Bank Nifty, unlike Nifty. So we have to see how it fares around 37,200, 37,250 levels, and then only take a call as far as Bank Nifty is concerned. So wait for a correction from this particular level, at least for it to cross something like a 37,000 before we look towards going on the buy side. And we have already talked about a 5% move as far as Bank Nifty is also concerned. So 34,020 is what we have seen. So 34,020 into 1.0556, that comes to 35,900 or so. So that's not that far off. So I think this is a weekly chart. So I think we need to look at even a 5%, 6% move from this level could mean around 36,000. Just to cross 36,000, at least for it to end up going up to 37,000 and then coming back. So Bank Nifty at this point of time, it is better to look towards a trend model rather than buying on dips. Okay, so Nifty definitely yes, you can for investment you can go for a dips, but as far as Bank Nifty is concerned, I would prefer to wait and see whether the Bank Nifty is in a position to sustain a trend, because otherwise there can be a deeper fall as far as Bank Nifty is concerned if things worsen. So it's better to wait for things to get clear, and even if you have to get it at slightly higher level, it is better to do that rather than jumping the ship as far as Bank Nifty is concerned. So let's look at some of the IT stocks. Now we have looked at the Nifty and Bank Nifty. Nifty, we have the confidence to go for a long. Even if there's going to be a fall, I think Nifty can recover on the weight of IT stocks, Reliance and L&Ts and other things. But the Bank Nifty still has a good weightage. But probably even if Bank Nifty recovers in a meek fashion, Nifty can recover a little faster. So Bank Nifty we will hold on for the time being, and Nifty we will have the confidence to buy on dips. So let's look at some of the IT stocks before to get an idea, because we have talked about the Nifty and Bank Nifty. So let's look at the Nifty IT index. So Nifty IT index is doing well. I think if you look at the Nifty IT index, it gives a very good confidence overall situation. So I think already it is in a bull trend. So I think we should be looking more towards investment in IT sector. And in the last 1 year itself, when we see how it has performed, when the Nifty is around 18%, let's look at how the Nifty IT has performed. So Nifty IT, it was 24,250, now 36,627. 36,627 minus 24,521 divided by 24,521. The fabulous return of 50%. Compared to last year, if you look at the last year, this one, which is the 24,251, and now it's 36,627. Fabulous return, fabulous return. So I think better to look more towards IT rather than even Nifty. Okay. So I think that's a very clear winner. And the last 2 years performance also, let's look at the performance. We'll look at the 2019 end. 2019 end was 15,652. So 36,627 minus 15,000, 16,000. Yeah, it was 15,000. 632 divided by 15,632. It has given 134% return, which means something like a 60, 70%, 65% return year on a year-to-year basis in the last 2 years. And let's look at even 2018. So whether it is comprehensively beating Nifty index. So this is 14,440. 14,440. $153 divided by 3, 51% return. So as against an 18% return in index, this has been giving 51%. So 3 times more. 3 times more. And even in a normal circumstances, when index does well or it doesn't do well, this at some stage it picks up and gives you a very good return. So this is a very fabulous return compared to any other this one. So again, it has started to go up. So I think we should be looking more towards Nifty IT type of funds which are available. Okay, so there could be ICICI Tech is available for investment. So better to concentrate on IT stocks. So now we will look at probably individual stocks like TCS. Okay, Tata Consultancy Services. Now, Tata Consultancy, the monthly chart has started to move up. And so that's a good sign. On a daily chart, looks to be now also slightly range bound. So maybe it will start moving up very shortly. So TCS is another great stock, and weekly chart looks fabulous again, because if you see, higher bottoms are getting formed, higher tops are getting formed. This is a higher top compared to this. This is a lower bottom, lower bottom, lower bottom. So I think TCS is now getting poised to go up unless something wrecks this market. Now, so then we have HCL Tech. HCL Tech looks good. Again, this is also a stock which is looking good. Now, on a weekly chart, also it has started to go up. On a monthly chart, let's look at it. Again, it has started to move up on a monthly chart, so that's a good forerunner. And again, this stock also, let's look at the last 3 years performance compared to the Nifty IT itself. So this was 476 and now it is 1205. Same thing like index, like ICICI IT index. So the return is as good as IT index. So we can go for ICICI Tech itself as a mutual fund. We can go for that. So this is also a very fabulously fabulous stock. Let's look at Infi. There is one stock which is doing extremely well as far as IT is concerned. That is the Persistent Systems. So this is doing extremely well, and last 3 years performance also, let's see whether it has been able to beat the index, IT index. It was at 655, now 1811. It is Infi has slightly outsmarted ICICI Tech by 7-8% over a period of 3 years, which means around it's performing 2 to 3% more per annum. So we don't need to take a risk. We can still go with the index stock. But again, this stock is it is outperforming right now even the IT index. It is now even outperforming the IT index. So this is another stock which is quite fabulous. So these stocks have already started doing well, so which means IT stocks are promising to up. And on a daily chart, of course, it has slightly gone up this, so it could probably still be slightly a range bound between 1848 and 1661. So any dip, I think it's a buy as far as Infi is concerned. So these are all investment oriented stocks. So most of the IT stocks are investment oriented stocks. But at the same time, on the trading basis also, it gives a fabulous return. So what more you want when you get on a yearly basis over a period of time 40-50%. So even if you have invested 10 lakhs in IT stock over a period of time, in 3 years time, I think you just look at every year it's producing something like 5 lakhs. So even for a 10 lakhs, I think you're getting a fabulous return. So what more you want, right? So I think ICICI, a mutual fund, you can look at it, broad-based mutual fund as far as ICICI, as far as the tech stocks are concerned. There's one system, let me see, Persistent Systems. Whether it is there, yeah. This has done well even in a bearish situation. Look at 4425. And this has done extremely well. Okay, even when the market is falling, this has done very well. It has held on very well. And if you look at the last 1 year return, it has been absolutely a very fabulous look at this stock. Quite scary, but look at this stock. This is just rallied something from the pre-pandemic level of 400 to 4425, 10 times, 10 times. Very, very fabulous, but quite upright, but still, see, look at this particular stock. Persistent Systems, this has done well. And let's look at any other stocks which are doing very well. Of course, the Asian Paints and Apollo. I think Apollo Hospitals, which should be seen from. This is another stock which really fabulously within a month or so it just rallied last month itself, and so this is one stock. Probably it may not dip much below this 4,000. So it looks to be another stock which is doing extremely well. 4856 is right now the price, and last year it was 2,412, which is more than double. So almost an 100% return in the last 1 year. And look, if you look at the last 2 years return, 1442, 4846. This is something like a more than 100% return, 118% return. So this stock, Apollo Hospitals, last 2 years performance has been extremely good, and last 3 years performance also, if you take, it was 1258, now 4856. Something like 95% per annum. So something like 95% per annum Apollo. I think another fabulous performing stock in the last couple of years. So any dip is a good opportunity to go long. And this is on a daily basis. No, this is now slightly, it has fallen to this. And the last couple of, this one, it has not come down much below the 200-day moving average. So we can wait and see to what extent there is a dip in this stock. This has started, always there is a correction which is only up to the this line, which is the 100-day moving average. It has not even come to the 200-day moving average for some time. But let's look at whether this time we get some opportunity closer to the 200-day moving average before we go on the long side of this. So I think probably any fall below this can put it back to this. So which will be a good level for investment. So Apollo Hospital is another stock which you please keep it in the radar as far as investment is concerned. So Asian Paints. Look at the monthly chart because it's slightly choppy right now. Again, this stock generally does very well as far as investment is concerned. And right now 3271, and 1 year back it was 2764. So 3271 minus 2764. Of course, it has done 18.34%, which is almost in tandem with the index. So it has not outperformed the index in the last 1 year. Normally it outperforms. So let's look at the 2 year performance as far as this one's concerned. 1784 and 3271. Two years performance, it has bet the index. Now going at 41% per annum return. So still the stock is doing something like a 2 years period, 41% per annum. And 3 years performance also has been extremely good. So this is another stock which you can consider. So in the diversification, you can look at Apollo Hospitals, Persistent Systems, probably Asian Paints, then some of the IT stocks, particularly Infosys is outbeating the index. So these are things which probably you can look at as far as addition, as far as investment is concerned. So these are stock ideas which we are giving, and probably this is from both from the statistical point of view of what has happened in the past, okay, and also how the chart looks like. Now, if you look at the IT sector, I think the stock is now the index is doing much better when compared to Nifty. Nifty is doing much better compared to Bank Nifty. So Bank Nifty is being dragged down by so many other stocks. Maybe out of that, the only stock which is outstanding is ICICI. So we look at ICICI and see whether this is doing better compared to Bank Nifty's index. So in that case, you can neglect Bank Nifty and look more towards individual stock. So if you look at it, now it's 720, and comparatively, no, this is the daily chart. Bank Nifty has broken 200-day moving average, but this has not broken. So it's still holding, and probably this is one stock which probably you can look at it. And for a slightly bigger trading call, just wait for this particular level to be clear. That is 770 to be clear before it starts resuming its a bigger uptrend. So normally the upside that has been given generally for ICICI, it will cross 900 or plus. And with better results next year, I think it is also poised to cross 1000 levels. So anything above 770, you can go for a long, which will also give a good return. On a monthly chart, the return compared to the index is 720 right now. And last year, if you look at it, it was 535. So 720 minus 535 divided by 535. So this has bet the index. It is 35%. It has given 35%. So 2 years return. Let's look at the that was also 538 and 720 right now, right? Sorry, this is 538 and 720 minus 538. Last 2 years return is 18%. This is almost the index type of return. So last 2 years it has performed only like the index. Last 1 year it has outperformed, probably because for a particular time it was much lower. 2018 time, let's look at the 1 year before that, whether these are all beating the index, so that we'll know 360 and 720. So that means 360, 100%, 100 divided by 3. So this is 33%. So over a period of time, over a period of 3 years, definitely this has bet the index. Last 1 year it has bet the index, and last 2 years it has performed in tandem with the index. So one stock which is trying to beat the index is ICICI. So on the bank side, I think you can look at ICICI. So overall, we are looking at something like this type of portfolio, that is IT stocks. And in that you can go for mutual fund, IT mutual fund, or ICICI Tech. Okay, this is one. Then in that itself we can look at persistent systems, which has done extremely well, but it is parabolic, right? So we have to be careful about persistent systems. Then we have got Apollo Hospital. On any dip you can go for Apollo Hospital. Then we are looking at stocks like individual stocks. We are looking at stocks like ICICI. So don't go for Bank Nifty. So these are some stock ideas which you are given. Then of course you always got the Nifty, straight Nifty. Okay, so these are things which you can look towards, look on the buy side basket you can as you approach this end of this financial year for a next year return. So we will continue this discussion. We will do some illustration along with technicals like Fibonacci and trend line on Friday. Okay, so if you have any questions right now, please ask me. Thank you very much. So right now I think there's no question. So right now there is no question, but hopefully this webinar today has given you some idea of the present market condition, as well as the stocks that you can pick as you as you come towards the end of this year and further next year basket. So even a smaller investment done prudently by identifying which is doing well and which is not doing well, I think the return can be fabulous. Okay, thank you very much, and hope to see you in the next webinar on Friday. Thank you very much. Bye.